Well, thanks for tuning in to Talking Point today. I'm your host, Niraj Shah. Now, strange things are happening in the investment world, isn't it? One of the news pieces that I read in an Ambit report seemed to suggest that investors bought about $1.1 billion worth of private bonds backed by Italy's most powerful mafia over the last 3 years. That notwithstanding, and that's a separate story in itself. But the more important point is we've seen the return of COVID-19 cases, unfortunately, and talks of lockdowns or countries and spaces re-entering into lockdowns. I mean, in the US, Texas, and some other states have spoken about it. India, we've already seen evidence of that with Bengaluru entering a 7-day lockdown starting tomorrow, as well as some other places in Maharashtra already into a 15-day lockdown. So what does this do to an already fragile economic recovery, which is contrasted by an equally buoyant stock market almost around the world? Let's try and put all of this into perspective with Mark Matthews. He's head of HR research at Bank Julius Baer, joins us right now on the show. Mark, so good having you. Thanks much for taking the time out and speaking to us.
It's my pleasure, Niraj.
Mark, just try and put this into perspective for us, the way you see the world and the investing world through your lens.
Boy, I don't even know where to start with that one. It's so big. I think the overriding force is still the coronavirus, and you're absolutely right to say that the rise in cases in U.S. states and in India is a problem. I mean, it's not good. I think more importantly is in America specifically. For the last 5 or 6 days, there's been a notable uptick in deaths. So I think many people were hopeful that, unlike the first major wave in the tri-state area up in the northeast of the United States, when the huge arrival of coronavirus was accompanied by very quickly a lot of people dying. Somehow it wasn't happening this time. And the idea was it was because the young people were going out to restaurants and bars, but because their immune systems are robust, they weren't dying. I guess what has happened is we've had a few weeks now where those young people have been meeting old people. And so the fatalities are rising in America, and it is not good. I would have thought it would put pressure on the market. Then again, the market is not a human being. It is some kind of living organism, I think, but it is utterly unemotional. And if the market thinks that this will be accompanied by more fiscal and monetary stimulus, I mean, I know it sounds horrible to say, but it might actually like it. So that's what I'm thinking right now. I'm thinking we need to watch this rise in the death rate in America very closely, because it could be accompanied by people being afraid of not going out. And the big problem in America is they don't seem to be able to practice social distancing very well in many places. They don't like wearing masks, etc. So we'll watch it closely, but I also think that the force is still with the market to go higher, because even if you look at this rising death rate, it's still extremely small compared to what was back in March, and we do have the government talking about another $1 trillion in stimulus.
So you're saying, Mark, that almost in a convoluted way and not diabolical, but in a very strange way, this rising number of deaths or the rising number of cases might actually be good for asset prices, because they might get inflated again by stimulus measures coming in, and the markets would not pay heed to potential future problems just right now.
It's a theory. I don't want to say for sure. And, I am a human being. I don't want people to die. But I also recognize that the market isn't emotional the way I am. So it is possible it is looking at it that way. But I think the main point is that, as I said, relative to back in March and April, we don't have, the massive number of people dying. However, if it keeps going up at the rate it's been doing in the last 4 or 5 days, I would think it would become worrisome.
Yeah. Yeah, by the way, sorry, Mark, if I kind of wrongly paraphrased you. I'm nowhere trying to say that you are happy with this happening. All of us are sad, but just that since we're talking markets and investing, that's why my question. So, therefore, Mark, let's try and put this into perspective. One, that the equity markets are doing what they're doing, and world over, we're seeing um, flurry of money moving towards businesses which might relatively seem insulated from disruptions in businesses, even earnings if they fluctuate. But if the businesses are less likely to get disrupted, the markets seem to be rewarding those disproportionately. Are you seeing that across the Asia Pacific region as well? Because we've seen that in US and we're seeing that in India for sure.
Yes, absolutely. I mean, the companies that went down the most were companies and businesses like retail. And however, I would say that unfortunately, with the exception of India, the rest of Asia seems to have handled this, or just been lucky to have been less badly hit by it. Countries like Vietnam and Thailand, actually, it's been very minor. So in America, though, it's true that the companies that have benefited the most are the ones that people will actually use more of, Netflix and Google and Amazon and that kind of thing, because they are not going out and about as much. I wanted to add one more thing. I wanted to also say that perhaps one thing that is different from back in March and April is the progress that's being made on the medical front. And particularly, I noticed there was an interview with the CEO of Pfizer, and it just came out over the weekend. And he was saying that they're so confident at Pfizer that their vaccine works. They're already starting production even before FDA approval, and even before they've finished their very final phase 3s. And they will have 100 million doses by the end of the year, regardless of whether the FDA approves it or not. But they're so confident that it works that they're starting already. That's one, but AstraZeneca, and you've got to remember, about 170 different companies or government organizations or universities are working on vaccines. So I think also there's a very good chance that we will have a breakthrough, or perhaps several, by September, October, and that's a good reason to, look past this spike in fatalities.
Yeah, it is. But you made a valid point as well that one, say, for example, before I get to India, actually, just one more global question, Mark. Let's assume that there are forces working for asset prices, which is this vaccine and the breakthrough and news around that, and the stimulus that we have, versus the impediments, which is the sentiment around maybe rising cases, if that were to dampen, and the fact that there are economic issues and job losses, which may impact the quarterly performances of companies for the next couple of years, say couple of quarters, say for a few. You reckon that the forces for the markets are stronger than the forces against?
I think you could be looking at a very bifurcated market, which is often what happens during crises. The innovative companies come out of them even stronger, and the companies that didn't innovate or just happened to be in the wrong time at the wrong place took years to recover. The one I would look to as the big winner is technology. Obviously, it's pricing that, so-called new economy stocks. And the big loser, unfortunately, is the industry that you and I work for, finance. You're in more the new economy side of it, though, so you're okay. But actually, there was a very interesting survey that Fidelity, big asset manager in America, they do a survey of the 170 analysts who provide them with coverage of stocks around the world on the sell side every month. And the survey that they did last month asked, when do you think your sector is going to get back to pre-coronavirus levels? Now, for technology, it was by the end of this year. But for financials, it was by the end of next year. So it's a full 12 months later. So I think what you'll have is a bifurcated market, unless we do get a big breakthrough in a vaccine. And then I think you could get a catch up in some of the laggards. But I think we're going to have a bifurcated market, just like you've had in India as well. The Sensex or the Nifty are down about 16% year to date, but Reliance is up 20.
Yeah, it is, and it's drawing investors across the world. Just overnight, we've had news of one more tiny investment, tiny in the context of what they've done thus far. But just before I get to that final, dwell a little bit deep with you on India market, because you have a really good view sitting from there into India all through these years. Just one India or an Asia specific question. You mentioned at the start, and rightly so, that India's kind of had this bit of a problem in managing the virus compared to the rest of the Asian economies. How are you and how are investors therefore viewing India vis-a-vis rest of the options available?
In the emerging markets and in Asia, it's really come down to China and everything else. And you will have noticed the stellar performance of China this year. One reason is that although the virus originated there, it seems so anyway, they have done a very good job at controlling it. Without, by the way, having to resort to a lot of fiscal and monetary stimulus. It's been interesting that way. The other reason, though, is that China is the only country in the world outside of the United States that has a very large new economy / life sciences sector. And they did that by creating this thing called the Great Firewall of China, where they excluded all foreign participation, pretty much all foreign participation in the new economy. So when you're in China, you can't use Google, you can't use Facebook, you can't use Uber, you can't use Netflix, you can't use any of that stuff. You use their stuff, and they make lots of money doing that. So anyway, I digress a little, but my point is that in India and in Southeast Asia and in pretty much everywhere in the world, apart from America, we use the American ones. We use Uber and Facebook and Netflix. And that has taken a big chunk out of our own domestic economies, because 10 years ago, we would have hailed a local taxi, we would have had a local television cable subscription, we would have had a local, telco when we're making our calls to our parents overseas, etc. So that's why Reliance is trading where it is, because it's the only thing in India that really offers any possibility of that. By the way, here in Southeast Asia, which is not a small place, if you add up all the countries, it's 600 million people, growing at about 5% a year. But the largest listed company in Southeast Asia is no longer Development Bank of Singapore. It is now a company called SEA Limited, SEA Limited. It didn't exist before 2015. 34-year-old guy set it up, who's now a billionaire. And it's a gaming company, but it also owns Shopee, which is the largest online e-commerce site here in Southeast Asia. Anyway, what I guess I'm trying to say is that people really want new economy, and the problem with emerging markets is they don't have it, with the exception of China.
Fine. Okay, so people, you saying, I mean, are you seeing evidence of that money managers are maybe more keen to invest in the Chinese economy, despite this whole conversation of the anti-China flavor around the world? And would that come at the cost of the other options available? Maybe for the right reasons, but still just asking.
Absolutely. I mean, I think it's like the trade war last year created all kinds of noise, and so many, hundreds of thousands of hours of people's time was spent researching it, talking about it, reflecting on it. And in the end, the markets were very strong last year. It actually didn't end up being the primary driving force of the markets. And this year, of course, there's a lot of talk about tensions between China and other countries. But as I said earlier, money is unemotional, and it will go where the returns are the highest. And it can see that these new economy companies in China, they have their equivalent of the FANGs. They call it BATs, which is hopelessly outdated, by the way, but Baidu, Alibaba, and Tencent. But there are actually now dozens and dozens, and soon to be hundreds more, of very interesting, highly investable Chinese new economy names. And that's what the market wants, because it is a 1.4 billion people, country with still very strong economic growth, and it has the kind of companies that you can invest in in New York, like Facebook and Amazon and Google, it has the same kind of companies and nowhere else in the world does. So absolutely, foreign money really is interested in that. The only way it would ever change, I think, is if there was some kind of sanctions and embargoes imposed by the United States on people buying that, which is a risk lurking in the background. But I think still, I wouldn't put over 50% probability on it.
Okay. So where does that leave India, Mark? Irrespective of flows, I'll get to flows in a bit and your thoughts there. But how do you view India in the current context?
I think right now it doesn't look great because I already addressed the first point. There's not enough new economy. There is with Reliance, and believe it or not, I think that'll keep going up. Geo platforms will probably be listed in NYSE and push it up a whole bunch more. I mean, Samsung Electronics in Korea, just to give you a benchmark, is about 18% of the KOSPI, which is their stock market index. Reliance is 12% of India's today. That gives you an idea of where it could go. But anyway, so not enough new economy. And then what else is the other thing is the twin deficits have prevented very robust fiscal and monetary response the way countries that have a lot of money have been able to. America, because it's the reserve currency of the world, has been able to provide fiscal stimulus somewhere in the order of over 20% of GDP. Here I am in Singapore, it's done around the same. The Australians have done around the same. There's quite a surprisingly robust fiscal response that'll be coming out of Europe over the next few months. But India can't. So there's less of an offset from the government. Then I suppose the sheer weight of the population, Bombay and Delhi being such densely populated places, it's kind of impossible to maintain social distance. But people have to go about their daily lives if they don't have enough money to get, so that's the problem. But in India's going for India, I would say first and foremost, it looks like the dollar is starting a path of depreciation. It's slightly premature to tell, but my gut feeling is it is. And we don't want the dollar to collapse. That's no good. But if it slowly and quietly falls over the next 1, 2, 3 years, that's just great for India and emerging markets in general, but certainly great for India, because one thing that keeps people away from the emerging markets like India is they don't want to lose money in the currency. Let's see, what else is there? And so then if there's a vaccine, of course, the countries that haven't been able to fare well, who have been really adversely hit, they could bounce back more quickly if we can see a real light at the end of this thing, like polio, and just wipe it out with a vaccine. And I imagine India would be good at making many hundreds of millions of doses. So the world is a changing place. Right now it doesn't look good, but who knows, maybe in 3 months it'll look very different.
Okay, one final question, Mark, and that is on the big issue for India ahead of COVID-19, which was this whole shadow banking issues that were there, and people thought that would be the big bugbear. It hasn't gone away. If anything, the risks for the NPAs are still lurking around. Is that something that could add further pressure, or do you think that it would be manageable?
I think it should add further pressure. Yes, banks have had somewhat of a reprieve because the second moratorium wasn't as large as expected. But I agree. When you've got NPAs system-wide at about 12%, probably higher for the government banks, and probably going higher as a result of the lockdowns, and generally depressed sentiment, yeah, it's an issue. And I think still about a third of the Nifty is banks. Correct me if I'm wrong.
Yeah.
So
I
do feel that it's unfortunate. Sometimes in a crisis, you can take advantage of a crisis to make dramatic changes. And one thing that would have been a pleasant surprise was if the government had come in and really been more forceful in addressing the NPAs. to me right now, it looks like a sort of case-by-case basis and almost a little bit like a witch hunt against individuals rather than a system-wide attempt to rectify it. And in the absence of a robust financial sector, then you don't have enough capital formation in a growing economy like India's. And I do think over time, the situation can gradually, organically mend itself as simply, good quality banks take deposits away from bad quality banks. But that's a process that takes many years.
You reckon, Mark, the sum and substance could be that Indian markets could actually see downside? I mean, unless, of course, the vaccine and the stimulus measures are different catalysts, but left to itself, ceteris paribus, Indian markets have a higher probability of a downside?
No, because I think reliance is going quite a bit higher. If you took that out, it might be different.
Okay, Mark, I wouldn't want to get into more stock-specific conversation with you, but this was super. Thank you so much for taking the time out and speaking to us today and giving us your thoughts. Stay safe.
You too. Bye-bye.
Thank you. Viewers, thanks for tuning into this leg of the Talking Point.